All right, so we got a little bit of a rebound today. The question is, was it enough of a rebound to really start us off on a new bullish trend up to the upside? Have we ended the pullback and we started the new move? We take a look at all that, right? We talked last night about a lot of the signals that we've been seeing that would suggest that there's been that we could have some more weakness. Did today change any of that, or did it help build upon what we were expecting? So that's the question. That was a question across a lot of the discussions I saw today on television in financial markets, with most of most people saying that we have now rebounded and we're now starting to recover. And if you followed me on Twitter today, I posted a lot of content there. Kind of showing what my thoughts were on some of those discussions, and I'll show you some of that as well here in today's video, taking a look, of course, at what's driving this price action here today at least, and then with our trade idea in an area, in the discretionary area that is rebounding and bouncing up higher, and we'll talk about how to trade that. So let's go ahead and get started. Today is Tuesday, August 6th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old Market Outlook trades, see whether we should stay in them, get out of them. We also put on today's trade already before the market closed. Come down here to the bottom, click this heart. It opens up this tab. Hit that like button there. Sorry, it didn't, for some odd reason, didn't pop up here. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who like this day in and day out. Those who don't, there's what it looks like there. So hit that like button right there. So those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. Obviously, we rallied today, not at the very close. We came down off the highs today, but we ended up rallying, ended up finishing more than 1% higher, 1% higher. That's on the NASDAQ here. The SPX, we were at 1.04% higher. We did go up enough that both the near-term line and the momentum line, but the near-term line crossed the intermediate line, which is good because the intermediate line is still between the reversal zones. But the intermediate line also turned up itself. So that's actually pretty good. So pretty good sign there. Again, coming off of a relatively bullish, far less bearish of a near-term low than what we've had recently. So a good opportunity here that we can really bounce up. Now again, as I mentioned before, I don't think that we will get a new high. I think that we are in the midst of at the beginning pullback of a correction. But still, from a technical standpoint, from the market forecast standpoint, there's a good chance. Again, we have 2 days to go from below 40 to above 80 on the near-term line to really feel good about ourselves, feel good about a new move higher up to the upside. So right now, we're just not getting that yet. We'll see, right? We'll see if that ends up being the case going into the end of the week here. It was a rather subdued rally in short-term sentiment, so that makes it less likely that we'll get another bullish near-term peak. Market sentiment line is falling. It's below the reversal zone, so it's in below the 80th percentile and falling. So weak bearish posture from a long-term perspective. Obviously, we've had dark pink shading in a red line. We are far below the moving average, so very good chance we can go back to dark pink shading pretty quickly. We had one day last week where we rallied, and we got green shading as a result. So we've seen this before, and we'll see if that ends up being the case again this particular go-around. We are still nearly 5% below, which again is pretty far below the movement. It's the second lowest point after yesterday's position below the 30-day moving average. So still, again, not the type of move that you typically get especially at the beginning of a pullback, which is you could still argue we're at the beginning of one, considering we just barely turned dark. We've only had a few days of dark pink shading and a red line, really only 3. days of dark pink shading ever. I mean, we had more days of dark pink shading, but again, not with the red line, not with the combination of the red line to go with it. So I still think there's more dark pink shading left to go here, and probably we'll finish the week with dark pink shading by the time it's all said and done. The NASDAQ obviously looks very similar. Short-term sentiment looks a little bit better, but the intermediate line is a little bit worse as it's actually in the reversal zone. So you have, and you're way below, still way below the 30-day moving average, and market sentiment's falling. So it looks pretty similar to the S&P 500. The Dow and the Russell looks a little different. We do have dark pink shading now for the first day and a red line. Because we have just barely crossed below 50. We're still out of bearish territory, but we just barely crossed below 50. Short-term sentiment still in bearish the lower reversal zone, so oversold levels. And then when you look at the Russell, similar pattern, barely crossed below 50. We don't have the red line yet. We have the bull tag that we obviously crossed, finished well below that. And then your short-term sentiment's up, but still in bearish territory. And you're still pretty decently, but not too excessive when you're talking about the distance below the 30-day moving average there. All right, now let's take a look at the weekly chart, and you can see again very strong candle. It's obviously not as big as it was yesterday, but still a pretty decently sized candle. When you look at the size of it, we'll go down, move this line here. To a minus 5.13, which is the size of the current candle. And you can see, again, we don't typically get this size of a candle during normal pullbacks. As you can see in all these other instances, typically, when you get this size of a candle, it means we're in something more than just a pullback, as you saw in COVID and then 2022. And we're still above the 40-week exponential moving average, and the PPO is actually still relatively high when you look at it. About the same distance that we were at the beginning, a little bit higher still when we got this size of a candle that actually did break the 40-week exponential moving average at the beginning of 2022. I've talked a lot about the analog here between 2021 with this pullback, very similar pullback, and then the bounce up higher, very similar, went up a little bit more this go around. And of course now, that would suggest now that we are currently having an analog to early 2022, which I believe that is actually the case. Obviously, we have 3 red arrows here across the board still. So despite today's rally, we're nowhere near a green arrow. I guess we're closer to a green arrow on the stochastic indicator for the S&P. All the rest of these are pretty bearish. So 3 red arrows and a red line, except for the Russell. The Russell still doesn't have that red line yet. Everything else has the 3 red arrows and a red line. We're obviously well below the 50-day moving average. We are moving into that filling in the gap between the 50 and the 200. That's what a pullback does, right? You get a pullback when you break that 50 and you start working your way towards the 200. Sometimes it gets all the way there, like we saw last summer. Sometimes it doesn't, like we saw in April. That's when you get your weaker pullbacks, and this is when you get your deeper pullbacks. And you do make it all the way down there. And right now, as of right now, this would still be considered a deeper pullback, as a correction doesn't start, again, as we saw in early 2022, doesn't start until you break the 200-day and stay there. So you make your way down to it, you bounce, you fail, and then you break the 200, and then you just end up staying there. And that's that. We're still far away from that. If that ends up being a possibility, we're still pretty far away from that. Even on the Qs, we're pretty far away from that as well. We've broken the 62% retracement of this last intermediate rally. We also broke the 38% retracement of the market sentiment rally off of the last summer's that Halloween low point there. So we've broken some pretty important technical support. Now holding the 200-day, which is keeping us from where the next level of support would be, kind of in this 420, 415, down to about 405 area. So right in this spot, we have, again, the value area as well, at the top of the value area, as well as multiple Fibonacci levels. Let's take a look at the DMI. Again, looking pretty bearish. You're still close to 40 at least on the negative indicator, well below 20 on the positive, so pretty bearish pattern there. Obviously, the Qs are showing a pretty bearish pattern as well. The diamonds and the Russell are just turning bearish. So you've just turned bearish on the diamonds, and then the Russell 2000 as well, even though their positive indicator still hasn't crossed below 20 yet. The negative has crossed above 30, but the positive still hasn't crossed below 20 yet. So that's kind of the next stage of bearishness for those two particular indexes. Looking at the RSI and the CCI, yesterday we talked about it breaking below 40. So we are red on the RSI. You have to break above 50 is when it would start, and then I don't draw the green box until that move gets above 60, and then we would start it back when it crossed 50. So we haven't got that yet. We're still in bearish levels, and then we also noted last night the weekly chart breaking below minus 100. It's still barely below minus 100. It was actually above it earlier today when we were at the highs of the day. So remember, we got 3 more days left to see, because that's a very important signal on the CCI as to whether or not we are going to move in the correction mode. Because again, corrections typically start when you break that 100 level on the weekly CCI, the negative 100 level. Let's take, at least we're bearish enough to have correction, because remember, you're going to have a bounce, right? You're going to have a failed pullback bounce. So breaking 100 doesn't mean that that we're going to end the correction right there. It means that we're going to start it, which means there's going to be multiple legs, higher and lower, during a correction. Let's take a look at the Ichimoku cloud. For the SPY, we have intermediate trend strength. We are below the minus 2.5 level. We are above the 65 level, so pretty strong, and we're still below the cloud. Pretty strong negative rate of change. We have a pink cloud now there. Same thing with the Qs, looks very similar. Diamonds and IWM is also kind of flirting with the cloud. Lost the bullish trend yesterday on the diamonds and IWM as well. They kind of rebounded a little bit, but still there's no trend. But I mean, from a positive development, there's no bearish trend either. But you can see the cloud's very flat because we were so flat for so long. We talked about the potential for a fake out, right? The mother of all fake outs. Well, this has the potential of being the mother of all fake outs, since we have now dropped back down, here. And just like we saw at the end of 2021, it's the same thing. We broke out to the upside. Everybody was talking about how great small caps are doing. We're going to break out and really head higher, but then it ended up being a pretty significant fake out, which is, again, a lot more bearish than if resistance had held in the first place and we just started to trend lower. It's a lot more bearish because it suckers in a lot of people that are very weak hands because they've gotten in late. It suckers in a lot of people thinking we're breaking out now. And now any kind of decline back to the previous levels is already representing a loss for them, rather than a loss of profits for people who are stronger hands, quote unquote stronger hands, that have been in it for a lot longer. Any kind of drop like this is just a loss of profits versus a loss of capital. Because they started their position so late. That's hence the weak hands and strong hands analogy there. Let's look at the Bollinger Bands. Obviously, you're back above the upper band, but still in the lower band. But you're still in the lowest quartile. Bandwidth is really taking off to the upside. The rally got you up above the band, but did not get you above the Keltner channel. So we're still pretty bearish. And momentum is still increasing to the downside. So pretty bearish levels there. Now let's take a look at the intraday chart. We did get a higher high and a higher low. In my class today, we talked about most likely we're going to hold last week's low as a resistance, but still probably stay above yesterday's high. Well, we didn't quite do that. We ended up closing down below, just barely, but in the after hours you can see we're kind of continuing the slide there. So not the greatest. A higher high and a higher low, but not able to close above yesterday's high point, despite how strongly bullish we had been. Especially with a lot of volume coming in at the end of the day, kind of goes to show what kind of volume it looks like. You can see the Arun still pretty bearish. We did not get a new low today. So the red line, but the green line still moving. Once it gets to zero, then we're kind of set up for the possibility of a bounce off of a low point, right? Just like we saw over here. When we finally get to zero, then we're set up for a bounce to occur, if it is indeed just a pullback. When you look at the volume and the trading range, you can see the range is higher, above average. That average is rising, so it's a pretty significant average here, 8.84, and we were up almost 12 points, so above average again. No gap to to add to that, and 84 million shares of volume. So another day of 1.5 times the average volume there, and you can see mostly negative, as you can see down there. Taking a look at those numbers relative, the ATR just continues to rise. It's up was 8.84 yesterday, which is what we're comparing it to. It's now up to 9 points, so it's up to almost 1 3/4 on a relative basis. And you can see the volume continuing to move higher again. We talked about this before over here, that when these lines start to move higher, that tends to be bearish. Right before I left on vacation, it was moving higher here. And that obviously we've really taken off since then. And volatility dropped today before pulling back up at the end of the day, and not surprising with the rally, but didn't, stayed above 100%. That's a key level. Since we actually closed above 115% yesterday, or at least really close to it yesterday, breaking up above 100%, staying above 100% is important if we're going to indeed stay bearish. And you can see we did that, right? We stayed above 100%. That's going to be the level that will kind of trigger if we are indeed bouncing back up off a pullback low point. And so far, that's not the case. The VVIX dropped, not surprisingly, but it didn't drop very much. It's still at very, very elevated levels, which means we're still prone to moves higher in the VIX and getting up to, in the mid 30s, as we saw yesterday. We closed, where did we end up closing yesterday? At 38.57. I'm not necessarily sure that that's going to be the highest close on this cycle. Obviously, we are, the market is willing to be that bearish, and we'll see if we end up testing it even by the end of this week. I would expect that we'll end up testing that level here pretty shortly. All right, now let's talk about what's driving this price action. You can see real estate's really doing well. The drop in yields has really benefited utilities and real estate, for that matter. We'll take a look at sectors here in just a minute. But utilities doing well. Bonds dropped today, which means bond yields rebounded in a big way. So let's take a look, and you can see commodities fell and the dollar was relatively flat. If I were to break this down to just today, you can see it a little bit more clearly. Right, so there's the end of the day drop in those major U.S. equities. International equities didn't do as well. They were lagging, and they didn't fall as much either. Gold and commodities dropping with the stronger dollar that we had today. High yield rebounding in a big way relative to treasuries, and a big drop in treasury. Now, if I were to take this back to Friday and Monday, right, so you can see the drop in bonds. It's still the best performing asset class over the 3-day period. Equities are still the worst performing asset class over that 3-day period, and the dollar is actually down. It's not, it's up a little bit today, but still down over the 3-day. Not really helping commodity prices too much, but down nonetheless. But really, it's that bond market, and you can see here's the yield curve, and you can see how the yields are just falling across the board here. But if I were to take a look at how bonds are doing, so you can see TLT really dropping, filling in some gaps and dropping down, but still at a very elevated level. So you're still well above moving averages, so we hardly are changing the trend to the downside. And when you get so far away from moving averages, for example, here, let me just show you, when you're this far above the 17-day moving average, as we were yesterday, which is pretty elevated, then it's hard to stay that low. I mean, even like over here, you still had some pretty big moves to the downside before still, continuing up and up and up and up. And that was at the end of last year when stocks were doing really bullish. Remember now, the correlation between stocks and bonds is positive, or strongly a negative now. So it's not as positive as it was back then. And now it's a negative correlation. So we don't, a move in bonds to the upside is actually reflecting an increase in risk aversion, not risk appetite. as you typically have when you are below long-term moving averages and you have inflationary concerns. And obviously, there's no inflationary concerns, as you saw yields are falling across the spectrum. So now it's more of a deflationary concerns, and so you can see that correlate. So it's rising. The 50 days cross above the 200 days. So you have your golden cross. The 8 and 17 day are still rising, and we're still strongly bullish. Even we're still well above the 17 day, and nowhere close to crossing below even the moving average of that particular MACD. Looking at the dollar index, the dollar index was bullish here. Let's take a quick look at its correlation with the S&P 500, because it has been negatively correlated, and you can see right now is more positively correlated, pretty strongly, the more positively correlated than we've seen in a while over the past couple of weeks here, a few weeks. So if I take a look at the dollar, and you can see, okay, well, it's broken below its 200-day moving average. And big break last Friday to breaking below multiple areas of lows, and then continuing here down towards 100. We've retested 100 at the end of last year, again when there was a negative correlation with the S&P. We retest that level again with a positive correlation with the S&P, and now we are more bearish. So it's not normal to have that correlation, but you can see what's happening. And then finally, from a commodity standpoint, it's really hard to have economic growth expectations increase in the future if commodity prices are falling as much as they are. In fact, we're getting new 52-week lows on the basket as a whole. And if I look at crude oil itself, you're well below the 200-day moving average, below the point of control, flirting with the bottom of the value area. So things have definitely turned south for commodities. And if I take a look at the correlation of commodities with equities, it's a positive correlation. So if they continue south, and you can see it more often is positive, and if it continues south, then you would expect equities will go down with it, especially considering it's at 52-week lows, and also especially considering that despite a little bit of a seasonal bounce here in August, for the most part it's negative going into the rest of the year. All right, let's take a look at the breadth improved a little bit. It did get worse at the end of the day. It was looking much better earlier. You're still below, just barely below the minus 35 level. But you're still above zero. At least you're still above zero. Once you break below zero is when you're really in kind of at least pullback mode, right, or correction mode. Again, if you go back to the last correction we had in 2022, the peak we were coming off of barely got above zero, which kind of goes to show the weakness. But here we are coming off of a peak, a very divergent peak in the summation index compared to where we were back in April. And so again, as you can see, when we have all these other pullbacks, we typically work our way down below 500, if not below zero, for kind of your longer term declines. And it appears that we're making our way in that direction as more and more stocks are finishing at those levels. Here's the 50-day. This would actually be the number of lows. I tweeted out about this number of lows on the New York Stock Exchange. Today we had about 47 new lows. 4% is about 115, I believe, is the 4% level. 2888. Let's see here. All the way around. Yeah, 115 is the 4% level. We were above that the last 2 days, not today, but we're still above the average, right? The 20-day average of those new lows. So again, it kind of goes to show we're in this mode of weakness, and it's definitely not exhaustion. As you can see, you have to get a lot higher, typically around the 20%, at least the 20% range, which for this would be around the 577. I mean, and even over here in this typical pullback that we had, 15%, you're looking at 433, and that's about where we got. So that's the kind of exhaustion that you need to really say, okay, we're kind of done with this minor pullback here, if this is indeed going to be a minor pullback. So yesterday's move was hardly an exhaustion level event when it didn't even get to 10%, it was right around 7. But it is above 4%, which means we're in the mode, right? We're in the mode of weakness. If I take a look at the number of stocks above the 50-day average, still staying below 250, barely, but still staying below 250. And then looking at the number of new highs and new lows so far, only at minus 99. So this is it takes that new lows number and subtracts it from the new highs. And you can see there's not very many new highs. That's why we're negative. And it still hasn't been updated yet for this looks at both the NASDAQ Composite and the New York Stock Exchange. But still negative, right? Still well below the average, which is pretty strongly positive, and still negative. So not the best sign of breadth from that perspective either. When you look at the sector rotation today, so let's go to the sector comparison chart, and you look at how things did here today. You can see real estate continued to be a strong performer. XLK was a big winner, up over 3%, obviously down to only 1.3% gain, well below real estate by the end of the day today. And you can see all your safety trades down at the bottom. Again, if I were to zoom out to the last 3 days, then you can see staples, real estate, utility are still your big winners. And XLK did so well because it was so weak, and it still is so weak. Along with financials and energy, which you would expect would outperform a little bit more significantly on a period where we're not so bullish. Here's your daily relative rotation graph, and again you can see utilities, real estate, staples, and healthcare, your safety trades, have the strongest momentum and the strongest relative strength, and everything else is doing okay. Your other cyclical areas that tend to outperform during periods of weakness. I think I tweeted out a few weeks ago, how these are all really strongly negatively correlated with the S&P. Their relative strength charts are negatively correlated. So when they're outperforming, that's not necessarily the most bullish sign for equities. And you can see technology and discretionary continues to move down to the left. So we're still kind of in the wrong mode for relative strength cycles here. All right, and that brings us to our trade idea of the day. So let's take a look at Shake Shack. Consumer discretionary stock, obviously a hamburger joint, pretty decent one, I guess, depending upon your tastes. They're out of New York City, at least, is the times that I've eaten it. If you take a look, obviously things since its earnings announcement, things have turned pretty good for the stock. You were in a pretty significant bearish intermediate decline with multiple clusters here. In fact, to the point where the weekly chart showed at least dark pink shading. Things have turned up for sure this week. Started to turn up last week. Didn't get they got the intermediate line to 43. Let's see here. Last week got the intermediate line, near-term line to 43, and then now we're up to 72. So we're working our way up here, breaking up above the intermediate line that's turned higher, turned back above 50. So things are turning back up. Dark green shading the green line already on the weekly chart, but you see that as well on the daily. The intermediate, like near-term line, coming off of what may be off a bearish peak, a bullish peak, now maybe a bullish low point as it's turning back up here. So that's a good sign as well. If you take a look at the weekly chart for Shake Shack, big transition candle on the earnings announcement, and now you have a pretty good bullish candle, Hakunashi candle above the 10-week exponential moving average. It's rising. The PPO is rising again, having avoided going negative there. We take a look at the 3 green arrow chart. Obviously, you're going to have 3 green arrows here and a lot of volume on the earnings announcement. You can see we had a lot of volume going into the earnings and then after the earnings, volume tapering off a little bit, but that's okay. It starts to taper off when you're at these high levels. You can see, if I were to take a look at this chart, you can see volume has been really high. So as these levels fall back down, then markets tend to be bullish. That's kind of normal for a stock to do that. If you look at the DMI for the chart, you can see things have turned positive as well. Above 30 for the positive indicator, not quite below 20 yet. We were below 20. But then we had a couple of down days that brought the negative indicator up to almost 25 and pulling back down today with the rally that we've had today. The RSI and the CCI, you can see they're bullish, above 60 in the RSI, above 100, having made its way on the earnings well above 150. got above 200, got above 300 on the CCI down there. If you look at the Ichimoku cloud, we are above the cloud, just barely, but we're above the cloud there. The cloud has stopped turning pink when it's plotted forward, and you can see the rate of change has turned positive. We do have a weak bearish trend, but you expect that won't last more than another day or two. As tomorrow I expect both those lines will hit down to zero. And then you look at the Bollinger Bands and the Keltner channel, and you can see we had dropped up, we're closed above the upper band. We pulled back, but we're still in the upper quartile of the bandwidth that's rising here after the squeeze play that we had, all those red dots. Obviously the bands have broke out of their Keltner channels, and we actually closed back above the Keltner channel today. That's a good bullish sign. So what I decided to do here was a bull put spread, or a long call vertical spread, a bull call spread, where I sold, and it was actually right around the 30 delta when I did it during the Market Outlook Live today, before the market closed, but now it's at low 20 delta, selling the 110, buying the 105, so it gives me about a 2-to-1 reward to risk ratio with that much flexibility for timing. So if it doesn't go up right away, it's okay. I got that much flexibility there, and then that's, again, a small risk compared to the reward that we're shooting for on this directional trade. Alright, well that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.